Welcome to Oregon Cash Flow Pro. My name is James Barber, and as you know, I'm always here to help you maximize that cash flow. But in addition to that, we also create specially designed high cash value life insurance policies that are a nice, safe, and efficient place to store our wealth when it's not being deployed somewhere else. This is a great place for our emergency funds. It's a good place to just have extra cash on hand that's waiting to be invested. And it's also just a great place to save money in general if we don't have anything else to do with it at the moment. Now, this video is going to be an update on one of my policies that's Inforce. We're going into year 5 of this policy, and I want to show you what it's done, how it's doing, what it's projected to do from here moving forward. And we'll kind of address a little bit of some of the fear, uncertainty, and doubt that is out there in the interwebs surrounding high cash value life insurance and what might be the proper design. So if that interests you, stick around. I've got a lot of good information coming up. So first, let's go through just a little bit of background on why we bought this policy and why we did the design that we did. So we're going into year 5 on this policy. When I first started it, our goal was to have the ability to max fund this policy over, I believe it was 10 or 11 years. It might have even been a little bit more. I forget. It was 5 years ago. And I don't have the original illustration from back then. I might have it somewhere, but I haven't been able to find it. But essentially, the goal was fund it at 10 times that base premium, or a little bit more than 10 times that base premium for 10 or 11 or 12 years, whatever the maximum that I can do it is. And at that point, drop down my contributions to a little bit over the base premium amount. And this was going to be a very efficient designed policy. High cash value at the very beginning of it, high cash value throughout it, potential break even in year 5, or around year 4 or 5. I think it was year 5 in this illustration, because we ended up getting a standard health rating as opposed to a preferred health rating or a preferred plus, which was what we were hoping to get. When you move to standard health rating, the actual underlying life insurance costs are a little bit higher than a preferred or preferred plus rating. And so I think our break even went to a projection of year 5. Now, break even, that means there's more cash value in the policy than we've paid into it. And we like to see a nice early break even, because that means after we hit that break even, we're actually profitable on this policy, and it will never go backwards. It will never become unprofitable. So we like to start out with our designs with high cash value immediately, because that equals liquidity. Liquidity means I can commit larger amounts into this policy knowing I'm not tying up those funds if something else comes up. If I encounter a financial emergency, if we get just financial hardship, somebody loses their job and we can't fund it at a certain level, or we need to tap into that cash value in order to either fund the premiums or meet some other obligation. So high liquidity is very, very important when it comes to the likelihood of success with cash value life insurance. If you have a low liquidity design, and I don't design low liquidity designs, there are some people out there that tout them and try to justify them in some way, but a low liquidity design creates risks in that you either can't make as large of a contribution as you would like to, or you do make the larger contributions and you're putting your finances at risk, because if you encounter a financial emergency, maybe you can't meet those higher obligations. And they carry a lot more expenses inside the policy. So higher expenses inside this policy means less cash value in your pocket. We're not dealing with that design here. I designed it to be optimized for cash growth. Now, with this policy, and we went with a Guardian policy, because Guardian is very flexible. It allowed us to commit to essentially $6,000 a year, but have the flexibility to dump in a little over $50,000 a year, according to the original illustration. And the illustration software limits us to what we can show for how much we're able to dump in above and beyond the base face amount, or the base premium. And that base premium, we set that in this policy at $5,000 per year. Guardian, with their current practice, even though I can only illustrate putting in like $50,000 a year, or a little more than $50,000 a year for 10 or 11 or 12 years as a max funded design, their current practice allowed me to fund it at an even higher level than that, And that's what we did. So my actual mech limit is right around 72,000 per year. And that's what we ended up funding this thing at over the last 5 years. Pretty neat that they would allow us to do that, even though I can't illustrate that. I'm unable to illustrate putting that in because of the software limitations. And in actuality, the software limitations match contractual obligations by Guardian. Well, if we have term insurance blended into this policy and the type of design that we did, we can put in up to 10 times or maybe 11 times the base amount. Well, that's by contract. Their current practice can be more flexible than what the contractual obligation allows. It can't be more restrictive, but it can be less restrictive. So their current practice is I can dump in more than what I was able to illustrate. And that ends up with a better performing policy than we originally anticipated. It's pretty cool. And so what I like to do is I like to track what it's doing year to year. And I put that out on YouTube for you guys to see so you can follow along with me. And if you're getting into these policies, you can look and see what might be the best way that I manage my policy. What am I able to do with it? What are the things I need to be talking to my agent? If you haven't worked with me and you can't just, reach out and talk to me about your policy, you can reach out to your agent, maybe see how your policy is doing and see if you have the ability to fund it differently in order to get better performance out of it. Or when you originally get it designed, if you're in the market right now, what might be possible from a design standpoint and why might you want to go with the type of design that we're doing here? Okay, so that's the background. Our plan, get in 72,000 a year. Well, originally 50,000 a year for 10, 11, or 12 years. I can't remember the number. But then ultimately fund it as much as they will let us. That was our plan. Okay. This is our current year. This is the current summary of where our policy is at today. I'm going to shift back to last year's and we're going to start. Actually, we're going to go to here. We're just going to focus on the top here. This is some Inforce illustrations that I ran where it gives us a little bit of a summary where we can look at what's the projected cash value at age 65, 75, and 85 at that time. So right here, we've got in May of 2022, we ran an Inforce illustration and we showed what happens if I max fund the policy, as much as you'll let me, from here out, based on what we've already funded it from when we started the policy. And we started this policy in March of 2020. So I think it was March 1st, 2020. So by May of 2022, this was the projection. You can see our annual is projected to be $6,000 going in each year. That's $5,000 for a base, $1,000 in paid up additions. Now that $1,000 in paid up additions covers our minimum scheduled paid up additions cost to keep that paid up additions rider active. That's all I have to commit to each year. I'm basically paying $500 a month in order to fund the base policy, and then I'm able to just dump in all the extra throughout the rest of the year whenever I want to. And my goal is to get it in as quick as possible because the sooner we get it in, the sooner we start getting the credit and the dividends from it. And so our growth and compounding will be faster. So in 2022, you can see the projected cash value by age 65, $1,086,207. By age 75, $1,605,171. And by age 85, $2,200,000. Let me slide this over. $2,248,542. And if we move over here to the death benefit, you can see those corresponding death benefit amounts as well. And they're going to be significantly higher than this because that's how life insurance works. We get a death benefit that's greater than the cash value if we happen to die. If I happen to die, or in this case, this policy is on my wife, if she happens to die in any of those years, that cash value gets paid out as part of the death benefit along with whatever insurance amount has not been matured yet, which is the difference between your cash value and your net death benefit. That's still the net amount at risk to the insurance company. Okay, so those are the numbers for 2022. We added money in 2023. We made our payments in 2023. Well, when we did a max fund design in 2022, we anticipated that we were going to, according to the software limitations, we were going to fund it the most that we could every single year. And that was the projection. Well, in by the time we got to 2023, I was able to max fund for that next year, which means instead of putting in like 50,000 or whatever the illustration allows me to show, I put in another 72,000. And so how did that affect our growth? Well, by age 65, now I've got an extra 22,000 in there. And by age 75, we've got a projected extra, 47,000. And by age 85, now we're up to 87,000 additional cash. And over here, you can't see it over here, but the death benefit went up significantly as well. Basically, the net death benefit went up by about 50,000 at age 65, about 80,000, now 73,000 at age 75, and by an additional little over 100,000 by age 85, 108,000 or so by age 85. So just 1 year's difference of me funding it at the maximum as opposed to what I could illustrate the year before. We've significantly increased the projected performance. Now let's go to this year. Again, we max funded it at 72,000, and the projection is now 1,144,000. Compared to 2022, we're up an additional $58,000. Just from the year before, we're up 36,000. We're up an additional 36,000. By age 75, from 22 to 24, from 2022 to 2024, we're up over 100,000, 123,000. And at age 85, it's now gone up by 200, almost 230,000. That's pretty good. I'm pretty happy with that. I'm pretty happy with these numbers. So let's take a look at a little bit more of the specifics with what we were assuming on funding here. Because you're like, well, I can just see the summaries here, but I don't know what you're actually inputting. So let's go back here. We're going to go to this May of 2022 plan. Oh, I do have the original plan in here. The original plan was right here. This was our final illustration. This was as applied for, where we just had the monthly payments. So right here, right above that, this was actually the original plan in 2020 based on the non-smoking rates. Okay? And take a look at this. Originally at age 65, we were projected to have just over $1 million. Our actual result after funding it for 5 years, almost 150,000 higher. That's pretty good. By age 75, 1.465 million. Now our projection, 1.728. That's almost 300,000 more by age 75 compared to when I first bought the policy based on the original funding. And I'm max funding it. I'm illustrating a max funding each year. Okay, so let's look at what I was showing for my projection in here. Let's go back to that original plan. Okay, here's the original plan. Oh wait, that original plan was assuming a top health rating. So we're performing well better than our original plan, which was trying to project a top health rating. Here's the actual projection with a regular standard health rating. It was actually 964,000 at age 65. And now we're looking at 1.144. That's almost 200,000 more. It's about 180,000 more by age 65 because we accelerated that funding. That's really cool. And here was the projection. The projection, it doesn't tell us. I didn't limit it here because I didn't need to when I did the illustration. When I do my Inforce illustration, I can't just go out to the max. So let's go to 2022 and let's take a look at what the projected contributions were. Okay, so in 2022, this was what we projected to continue funding it at. It was going to be another 44,000 for 4 more years, 4, 5, 6, 7, and 8. Make that 5 more years. And then 12,000 in year 9. And then after that, it just drops down to the base, 6,000. Okay? There's no additional extra. Well, this is additional. This is in addition to the 6,000 base. So it's actually 50,000 for these 5 years and 18,000 here in year 9. And then 6,000 thereafter. So by year 9, compared to where we're at in 2022, we would have contributed an additional $268,000 in new premiums by year 9. Okay, and that's our max fund. That gets us to the point where we're going to drop down and just put in $6,000 a year from then on. Okay, $268,000 in total additional premiums paid. Now in 2023, the difference between May of 22 and March 23rd of 2023, we put in 72,000 instead of 50,000. So we put in a little bit extra money. It changes our projection at that point. So now I can no longer put in that 12,000 here, but I can still put in essentially 50,000 for the next 4 years, years 5, 6, 7, 8. So if I do 4 years here, we've got an additional 200,000 that we're projected to put out beginning from when I did this. So from 268 to 200, and I've overfunded it on the projection. I put in at 72,000, right? So in actuality, this was, if we go back from March of 2022, or if we go back to May of 2022, this is an additional 272,000 that we're projecting instead of 268. Now, if I recall, it's not going to actually let me fund it in that year 8 at that full 50,000. And we do have the illustration from 2023. So if I look here, yeah, it's actually 50,000 a year and then 35 in this year. So it's not actually, we put in 72,000 here plus another 150 plus 35,579. So it's actually 257,000 in total. And then let's add in year 9 because that extra 6,000. So plus 6,000 brings us to 263,579. So instead of the 268,000, which was what was anticipated here, now our assumption is that we're putting in 263,000 before we drop down in year 9 or in year 10 and start just contributing 6,000 a year. So that's the apples to apples comparison. The projected growth went up, the actual contributions went down. So we went down by about 5,000 in total cash that we're putting out, and the amount of growth went up by 22,000. That was a $27,000 swing. That's pretty good by age 65. I like that. Now, let's see what our projection is for this year. We funded those other 2 years at 72,000. It is now allowing me to fund the full 72,000. It's allowing me to illustrate putting in the full 72,000 in year 6. We funded year 5 and we funded year 4 at 72,000. So that gets us to 216. And then we have one more year that we can fund at 27,499 plus the 6,000 base. So that's another 33,449. And then we have 2 more years, year 8 and year 9, where we're going to put in 6,000. That gets us to a total of 261,000. And from then on, we're at that $6,000 contribution. So we're really close. We're really close to the year before's projection in total cash outlaid. That one was 263. Now we're at 261. From 2022, we were projecting to put in an additional 268,000 by year 9. This one, 263,000 by year 9. And this one, we're now at 261,000 by year 9. But our cash, our expected cash value has gone way, way up. This is exciting. This is why when my anniversary rolls around, I'm excited to fund these policies at the maximum that I can fund them at. Because almost all of it turns into cash value. Every time I put money in, almost all of it turns into cash value, beginning in the very first year because of how we designed this. So I'm not losing access to that cash value. But if I don't need it for something else, it has the opportunity to start growing. And if I do need it for something else, I get to access this cash value like a line of credit. The cost is somewhere around 5%, between 5 and 6% interest for the rest of my life. I can always access that cash value. And I don't have to pay any taxes. And the growth happening in here is tax deferred. And if I don't ever withdraw it, other than with loans, it's going to be tax-free growth. And eventually that death benefit is going to pay out tax-free to my beneficiaries. And that death benefit is going to be above and beyond the cash value, plus the cash value that I haven't used personally. So if I use it, taking it as a loan, the death benefit will pay the loan off and the remaining amount goes to my beneficiary. So there's so much flexibility in what we can do with these things, and how you end up funding it can make a huge difference. So what I like to say to people is if you own a cash value life insurance policy, the best use of that policy, the best way to fund it is to put in as much as they will let you. Now, if you have bad design policy, and there's people that buy bad designs all the time, unfortunately. If you have a bad design, always find out If you can fund it at a higher level, what will that look like? And that'll tell you if it's worthwhile to keep it or not. Oftentimes, even a bad design can be worthwhile to keep if you've already gone through the illiquidity phase and there's no getting any of that money back from the expenses of an early design on a bad policy. Okay? But it doesn't mean you're necessarily going to get rid of it. But can you make it better by funding it differently than you have been? Maybe. Those are one of the things that you'll want to check. So let's take a look at the actual numbers in these from last year to this year. And we have those Inforce illustrations. I couldn't find the prior ones. These are the numbers for 2023. You can see here, March 23, 2023. So here's the projection. We can see, let's look at the guaranteed columns. Because the guarantees, this assumes no dividend growth at all. We're only going to get the guaranteed growth that's going to happen inside this policy. Well, just from the guaranteed growth, it looks pretty good. Let's go by age 65. At age 65, so our guaranteed growth, $991,814. That's not too bad. Okay, so here's our illustration for this year. You can see April 11th, 2024. And let's look at the projected numbers. At age 65, we're at just over $1 million. Guaranteed. So the guarantee went from $991,000 to just over $1 million, $1.3 million. That went up by $12,000 simply by funding it a little bit differently and a little bit lower. There's about $2,000 less that we've put in by this time in this illustration, and we've got guaranteed $12,000 more. All right, I like what I'm seeing. I'm pretty happy with this policy that I bought 5 years ago. This is exceeding our expectations because I was pretty happy with the illustration as we drew it up when I bought the policy, and now it's performing even better than that. So that's really good. So let's take a look at what's going on behind the scenes. This is going to be a little bit of a deeper dive than you're used to seeing from any other channel, I think. And we can do this because this is my actual policy. We can see the numbers and how they work out. You can see here, this one's from this year. I've got this one from the year before, and I've got this one from 2022. Okay, here's that design. $5,000 base premium. We've got some 1-year term insurance blended in. This is the cost of that 1-year term. This is the scheduled paid up additions that we make each year for a total of $6,000 that we put in. This number plus this number. Okay, that's our $6,000 premium for the year. That's our minimum. That's what we committed to doing on a minimum basis. This is the cash value, the current cash value of what we've paid into the policy so far for that base premium. This is the cash value from the dividends from that base premium so far. And this is the cash value of all of the paid up additions that we've put in so far. Notice there's a really big discrepancy. The reason we do this type of design is because those paid up additions turn into almost all cash value right away, and we end up making money on that sooner. We get growth immediately out of this policy. This is the death benefit amounts that these numbers all represent. Okay, so there's your death benefit amounts. This number here is the current cash value as of this date for the base amount. We can see that corresponds to this right here. Okay, now I ran this right after that anniversary, so our March payment probably hadn't even processed yet. Our cash value on the base amount goes up every month because that's our mode. Cash value increase per mode. Our mode is monthly. Our cash value goes up by $290, and so it's projected at the anniversary date of the next year, it's going to be that much. That's based on the base amount. That has nothing to do with the paid up additions. Let's see how that went up from 1 year to the next. All right, so we can see here our cash value was 7599.36. That matches exactly with what was projected the year before. The cash value increase goes up. So this in 2023, instead of it going up by $290 per month, now it's going up by $301 per month. Now each month I'm making a $600 payment, remember. Not quite all of that is the base. Some of that is that paid up additions. Okay, so of that money I'm putting in each month, a pretty significant portion of it is turning into cash value, even on the base portion at this point in the policy. And then as of the next policy anniversary, it's projected to have 11,218. Let's go to the next year, 11,218. So this is this year. So those match up exactly. Now the cash value increase is up to $312 per month. And our projected value next year at our anniversary, $14,973. So this is all working as expected. The only thing that's different, the only thing that changes is what happens when I put in those extra paid up additions and how did that affect the policy? Well, take a look here. The way Guardian works, every time I make a paid up additions payment, it buys a little miniature whole life policy that's paid up. And that death benefit that it buys replaces some of the term insurance that I had to buy. Now, we were buying that term insurance as part of this policy because it reduced the expenses and it gave us all that cash liquidity up front and it accelerated our growth, making for a very efficient designed high cash value policy. Well, we can see here the cost of the 1-year term in 2022 was $722.92. And that bought $951,000 of term insurance. Well, by 2023, because I made a very large paid up additions payment, now we only have to buy $668,000 in term insurance, and the cost of that $588. Our policy got a little more efficient, so it went from $722 of a cost to $588. We still have the same death benefit, because notice our paid up additions death benefit went up. So all of these numbers still add up to the same amount of death benefit. It's just that I'm paying less for this. Now the next year, let's go one more year into it, and now our cost for the 1-year term is down to $344, and we're only buying $391,000. Again, still the same death benefit, but we reduced our cost because we dumped in those extra paid up additions. That's the key to a more efficient policy, is we wipe out that term insurance so we don't have that extra cost. And term insurance, remember, goes up in cost every year as you get older. We don't want this term insurance to be a part of this policy when we get to 75, 80 years old, when the cost of term insurance gets expensive. So under our plan, and what's actually happening is we're reducing it significantly, what we're paying for. And we're doing it as early as possible by max funding this policy. And we can see by the cash growth how effective that is. Okay, so let's take a look here at another thing that's happening behind the scenes, and that's the dividends. The dividends that pay out above and beyond the guaranteed growth. And we can see here, we've got our current dividend, and we have our current year dividend on paid up additions. This is for 2022. Okay, let's see how this is affected as we dump in more cash into the policy, and our policy's growing in cash value. All right, well, we can see here it's gone up to $2,000 for our current dividend on the base and $6,800 on our paid up additions a year later in 2023. And then here in 2024, we're now up to $3,000 on the base and $11,244 on our paid up additions. This is what we like to see. We like to see these numbers continually going up. It should go up. Our cash values are going up every single year. But it's just kind of neat to see the numbers and how they're actually going up based on these things. So that's about it for this video. I'm going to finish this with a screenshot of our summary, which shows our cumulative outlay from today. This is a report that I didn't include in the prior illustrations, but I'm going to include it from here on out because it shows how much we've actually put into it. I don't have to plug those numbers into a calculator and try and guess at what we're projecting for what we're funding it at. So in this scenario, by age 65, we're projecting to fund this up to $538,550. And then we have our projected cash value. This shows our projected net increase in cash value, and then our death benefit at those ages. And so I'm going to scroll down. This is through age 74, and then this is through age 100. Now I have this projecting us to stop funding it here beginning at age 85, and we put in a total of $652,000. Our projected cash value, $2,475,000, and our death benefit, $3.175 million. All right, so that is my policy, where it's at today. By now, hopefully you can see the value in this type of a design in having that liquid cash and the impact of funding it at the maximum level that we can get into it. If you're interested in seeing what this might look like for you, schedule a meeting with me. I've got my link in the description below to my Calendly. My Calendly is open to anybody that watches this, including other agents, I offer a 20-minute free consult to everybody. We can talk about anything you want during that free consult, okay? Anything you want. Doesn't even have to be life insurance. I don't recommend that you schedule a meeting with me and we want to talk about sports. I don't watch sports, okay? I do have a wide area of knowledge. I have a very broad base of knowledge in the financial industry, helping people in a financial advisor capacity. And I have a very deep, very in-depth knowledge about helping people maximize their cash flow and designing and selling high cash value life insurance policies, whether it's whole life or IUL. So if you're interested in getting something like that, or you need a second opinion, you want me to look at an illustration you've got, maybe show you a competing illustration, maybe with a little bit different design, everything that I design is optimized for your benefit and to meet your goals. Now, most of the time, the people that contact me, their goal is the highest cash growth that we can get. Sometimes it might be the highest liquidity, which may or may not line up with the highest cash growth. It depends. There's some slight differences. Sometimes you can pay a little bit extra to get a little more liquidity. Most of the time with a good design, we don't need to worry about that because we get plenty of liquidity by just reducing the expenses and not adding another expense, which would be a rider that might create some additional liquidity. We usually don't even need to do that with a proper design. So I hope this gets you guys thinking, and I look forward to hearing from you. Schedule that meeting with me if you want to talk about anything that you think I might be able to help you with, and we will see you next time.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.